Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Saturday afternoon, right after lunch, for me at least. We are in the middle of August, and welcome back for another weekly market recap. Now, we have seen throughout the week we just ended, from the economic calendar standpoint, it was pretty much an eventful week. But, at the same time, or on the other side of the coin, I might say, from a price action standpoint, for different markets, so kind of like across the board, the market didn't really move a lot, at least, directionally. Yeah, we got a bit of volatility, a few spikes here and there, but if you look at the week in its entirety, a lot of markets they just maybe just pumped and then have been faded or just dumped and then rebounded. So not a lot of a strong directional type of a move. But let's have a look at the economic calendar first, right? So the main thing, of course, was CPI came out on Tuesday. It came in line with expectations. So 0.2 as the month-over-month read, which brings the year-over-year read at 2.7%. So unchanged compared to the previous read. And it looks like again we are not seeing inflation really reaching into escape velocity, so to speak. So no real acceleration in inflation, although this data point right here will be kind of countered by what we are looking at very shortly right here, right? So then we got, of course, PPI. So look, PPI was a massive surprise to the upside. The month-over-month read rose almost 1%. And look, here's where you're gonna listen to a lot of many different opinions in my view, which is fine, I guess. At the end of the day, that's what markets are for, right? That's what makes a market, different opinions. I think, although the data is a big surprise, and quite honestly, I wasn't expecting such a strong data point, but you would need, in my view, to keep on monitoring these at least for another 2 3 months or something like it, having another 2 or 3 reads added to the data set, because there's always the usual suspects. Sometimes it's just a base effect, sometimes it could be seasonality, and there are a lot of different statistical quirks which kind of creeps into these type of data. So uh, it's a big surprise. Yeah, does it change the overall picture, or at least for me personally, does it change my overall view on inflation and where inflation should be headed? Not really, or at least, not just because of one single data point printed. But, nonetheless, the market was particularly interested in looking at and accepting and analyzing these results right here. The thing for me would be now, even if you are in the inflationary camp, what you could try to look for now is, okay, if you thought that tariffs would have been inflationary, so you are standing in Powell's court, right? That should be the first sign that maybe you're right. Okay, finally, the tariffs are showing up in the data, and I guess a point in favor of that argument would be, you know, because now we are actually seeing tariffs being implemented. Up until this point, or at least last month or something like it, it was all a talk and a negotiation and all these dealing tables and whatnot. Now it looks like we have a much more defined picture, and tariffs are actually being implemented with specific percentages and rates. So now you might see the impact of tariffs. Um, and that that would put you a bit more in the inflationary camp. The other argument would be, okay, but that just tells you the story on the producer side, right? So in order to have broad inflation, so the headline CPI going up, you would need to see these producers actually being able to pass on these inflation onto consumers, all right? Because otherwise you're not going to see CPI going up. And the result would be that the producers would suffer inflation. Consumers are actually rejecting potential increases in prices, And who's going to eat up the tariffs at the end of it? The producers. So what's going to happen next? If you see the producers being hit in their profit margins in order to defend them or to maintain them, what could they do? If they see that although they are suffering inflation, they're trying to pass it on to consumers by raising prices. If they see consumers are no longer show up or are just unable to keep up with higher prices, they are now losing volumes, right? So overall, the bottom line as for profitability is impacted, and in order to maintain that, they could start cutting heads, right? If they cut heads, though, overall, imagine it on a global scale or on an entire economy, right? What's going to happen is that you're going to have less people employed, less people with ability to spend, and over time, even less revenues and profitability for these companies. So again, it's a little bit like being stuck between a rock and a hard place, in my view. And all things considered, for now, I think you are obviously free to have the opinion you want. I would say for me, I keep on maintaining my previous opinion, which is lower inflation into the future, disinflation, and all the rest. But I think, a data point like this should not be discarded. And it's just some sort of a warning sign. Like, if you had a thesis before, now it's the time where maybe that thesis will be put to the test. So watch very carefully over the next 2 or 3 months and see if we actually have a shift in the trend, or this is just maybe an outlier, maybe a quirk in the statistical adjustments or data collecting or whatnot. Okay, so pay attention to what's going to come next on the inflation side, I guess. All right. Now, um, as for the annual change, still talking about PPI, we are still kind of in this range. Didn't really move a lot. So again, you would need to see a bit more of a sustained type of a trend to the upside. Okay. Now, after that, on Thursday, we got the jobless claims as usual. Again, last week we said it was looking like potentially a bottoming formation, if you want to look at that as a price chart, but pretty much inconsequential for now. But what we were particularly interested in, it was still this chart right here, at least for me, the continuing jobless claims. And it looks like although we had a read a bit lower than the previous one, but still we are at very high levels for now. So still, for me, this is still concerning as for the labor market. And again, uh, if you follow my logic, if you are concerned over the labor market and you know that if the labor market goes, spending capabilities in the overall economy will go, and without spending capabilities, you don't have revenues and earning growth, right? So with no earnings growth, what you have in the stock market or other risk on assets. Guess you know what I'm going with all this logic. But again, it might take time, right? I'm not saying it's going to happen tomorrow. I'm just keep on monitoring these data points and see if there are still kind of announcing the same end goal or final conclusion, or if at a point something could actually change, right? On Friday, closing down the week, we got retail sales, which again, if you look at them, still, in my view, they are not really enticing yet. I've been saying it for a long time now. This is the kind of data which, in and of itself, it's already volatile enough. So I would think that in order to establish a clear trend, it would be much more beneficial maybe to use some sort of a moving average instead of the data point alone. And on top of it, always remember, I continuously remember that to people when they come up with retail sales. These are nominal, right? So these are not adjusted for inflation. And if you check the different data points that we had throughout basically the last maybe 18 months, and then you adjust them for inflation, these type of retail sales, to me, they are really shy of that boundary where you would start to think of a recessionary territory. Now, why retail sales are actually important, you might ask? Well, beyond the obvious. But from a statistical standpoint, these data point right here, it represents 40% of PCE price. No, sorry. What was that? Price consumption expenditure or something like that. But I mean, it's the favorite Fed metrics when it comes down to assess inflation. Um, so if they are 40% of PCE and PCE at the end of it, it's 70% of GDP, you can understand why, fluctuations or big movements in these data set could, be reflected down the road, all right, in the macroeconomic type of a depiction that you could look at when you're thinking about the overall economy, okay? Then we had the Empire State Manufacturing Index, which again it ticked up again after ticking up in July. So I mean, you might say a little bit of a rebound, but if you check over the last 1 year and a half, more or less, I see more negatives than positives. So still can't be particularly happy over it, right? And we got the Michigan consumer sentiment, but I think this was the preliminary type of data, so not really the final. Yeah, I mean it came in kind of where it was supposed to come in, I guess, slightly down from the previous read, but still in this range right here. So there is still the potential for a rebound, maybe. But also, of course, bear in mind, this is just a sentiment type of a survey, and we have been talking over the last 2, 3 weeks about, my opinions on these surveys when it comes down to sentiment, right? As for the rest, just as an overview, GDP now it's still showing up at 2.5%, updated to basically yesterday, August the 15th, and as for the rest, Trueflation PCE still giving you a rate of let's call it 2.7%. And Trueflation for the headline CPI, it's around 2%. So basically on target, if you consider, valuable or correct the target that the Fed established. But, still in this range. Again, it's not really going anywhere yet, right? So it's just, it could stay here for a while, I guess. So probably just frustrating both parties, right? Those in the massive inflationary camp and those in the disinflationary, deflationary camp. So up until the point we don't have some sort of a catalyst to, you know, just throw the equation out of balance, I think this is the type of environment we could keep on seeing. All right. On top of all of these, if you check FedWatch, getting into September, now the market is currently pricing in a 92% chance of a cut, which, if you just check compared to 1 month ago, we basically moved from 54% and then 88, almost 89, and now 92. So yeah, still the market is pricing in a cut in September. I think, the discrimination, it would be in between the 25 basis points and the 50 basis points. Up until last week, I was thinking that, although it might seem a bit out of the ordinary, but considering what we have seen just last year in 2024, 50 basis points for me, it was I mean, I'm not going to say it was really my base case and I would bet the farm on it, but it was a very likely scenario if the data would have kept on deteriorating at this current pace. Now, again, would you think that just because of the PPI read that we got, the entire logic, at least inside the Fed, could change completely? Maybe not. But I still think we've been used to, especially Powell. We have been used to see the committee not really wanting to disappoint market expectations in order to don't to not spook the market. So I think the cut, it's on the table. 25, 50. I guess I still think there is a possibility for a 50, but maybe at this point we will need to have a bit more of a kind of concerning data point coming out in order to just put the final nail in the coffin for the 50 basis points in September. We'll see about that. Other inflation metrics as kind of like the break evens for now, again, same as the charts we were looking at on Trueflation right a minute ago, just ranging, not really going anywhere, right? So again, not definitive for me. All the rest, it's pretty much you know, uh, kind of in line with what you would expect in this period of the year. So, I'm not surprised to see, data points coming in and being kind of surprising, but at the same time, the market really not taking some sort of a very decisive and, you know, uh, strong direction with a lot of conviction behind it. All right. So we're going to move into the charts now. And let's start out with the DXY as usual. So as you can see, right, the DXY closed down last week, coming down a bit. It rebounded and then it kept on falling. Another rebound on a Thursday, and then on a Friday we closed on a bit of a weaker type of note. Now we are still hovering around this base right here. I think we kind of lost the momentum for a sharp rally, and we might keep on building up these bays at these levels, kind of forming some sort of a rounded reaccumulation up until the point of course we don't start to, well, break the lows and keep on making new lows, right? At that point, that's your confirmation for trend continuation. Um, should you be particularly concerned for a weaker dollar relative to all its pairs? I mean, it depends, right? It depends on what you are actually doing or what type of aspect of the macro picture or financial markets you're looking at. If you're looking at risk on assets, for instance, I would say a weaker dollar, it's usually associated with risk on assets which are performing particularly good. I've always said, to me, it's not always the case, especially when it comes down to the relationship in between the equity market in the US and the dollar. But, that's at least, that's the common narrative. All right. And for now, if you just look at the chart, what you could see is that, well, pretty much the equity market performed particularly well, while the dollar was actually weakening. So, still, um, it looks to be a narrative which is holding water for now, right? Now, where do you think it's going to go from here? Getting back to the DXY on the chart, I don't have a strong opinion, to be quite honest, at this point. Still, at least on a daily time frame, you could still looking at it and saying, we put in a higher low, a higher high. Are we trying to build up another higher low in here? So, that should be your main type of concern right now. So if we can reaccumulate in here and try to a new push higher, then, well, all right. Where do you see invalidation for that thesis? Well, if of course, if we break this low right here first, as a preliminary warning, and then if we completely give back all the bounce so far, breaking below this low right here. So up until it doesn't happen, I would say I would err on the neutral side for now, and then we'll see. I think we just need a bit more market generated information in order to assess this one with clarity. All right. As for foreign currencies, of course, they just follow the exact opposite pattern. So you've seen a good enough rebound in the British pound. The euro kept on grinding to the upside after this sharp drop that we've seen at the end of July. And as for the rest, you look at the Canadian dollar, still ranging behavior. It's not really moving a lot. It's, you might say, what, we are coming off of a series of lower highs, right? And we, eventually broke this low right here, and then it looks like for now we failed this bounce right here. So maybe there is a bit of space for farther downside in here. Yeah, could be, but overall, where do you put, what's your reference point? What's your um, invalidation point for these upside momentum? It depends on how much you want to anticipate things. For me, at the end of it, I do consider the dealing range to be in between here and here. So up until the point we can stay in this range, still on a macro scale, I would be neutral more than anything else. The Japanese yen, it's really compressing. It got a bit of a dip, but then a sharp rebound. And for now, we are just seeing it really going into a contraction. So I guess, even in here, the trend is still uh, going down from here. And I would bet on trend continuation up until the point I'm told otherwise, right? Uh, just for the sake of it, remember that this chart, same as this chart, is inverted. So, just take it with the, with a grain of salt when we are looking at going up, going down. Just always remember it's inverted, right? And moving along, not a lot to say about the other currencies, like, you know, it's still the same. Indian rupee particularly weak, Brazilian real particularly strong against the US dollar. The Russian ruble, it's basically following that trajectory we kind of identified a few weeks back for now. Still on track for a bit more of a downside move for now. Although, it's a bit sloppy. It's moving a little bit slowly, I guess, but still the pattern for now it's respected. The Australian dollar, it's kind of the same. It's the same of the Canadian dollar. It's moving very slow. Not a real directional bias on this one. So I'm not particularly interested in currencies these days, if not the euro, but just because that's my own, right? Let's have a look at what's that? Oil futures. All right. So, oil came down a bit more. I remember last week we left it in here. So the point was, okay, we are now sitting on a base, so we might have the potential for a bit of a bounce, right? It looks like we had it. There is more on a Monday. And then immediately we dropped a bit lower, getting deeper into the lower base. So at the end of it, this entire fractal right here, right? You could divide that in basically a little bit of a, three zones or three thresholds, right? You have your preliminary base or upper base in here. You have some sort of a midpoint in and of itself. This one was a little bit of a fractal of the overall movement, right? Because you see it forms a base in here and you got this tiny little block in here, which it's part of the bigger type of a block, which has, of course, its own base and all the rest. So nice behavior right there. So we tested call it the bigger base, right? The base of the bigger fractal right in here, anemic bounce, and we dipped a bit below in the base of the smaller fractal right in here. That generated a bit more of a bounce on Thursday, but again, Friday was quickly faded. Not completely, it wasn't completely negated, but nonetheless, we retraced back pretty much all of what we gained to the upside. So same reasoning on oil. I'm looking out to the global economy. I don't see a lot of strength in oil, and I know everyone is talking about. This is always something that I find particularly funny. Everyone is looking at one side of the equation, right? And they say, but what about the supply of oil? So what about the Saudis or the all the countries in the Middle East, if they are restricting supply. Okay, so well, look, they have been cutting supply for over a year now, and no matter what they did with supply, price kept on going down. I mean, at a point, you need to just stop and think for a moment. If it's not about supply, what could it be? Wait, could it be demand? Could it possibly be that although they're cutting supply and there's always less and less supply, demand is falling even faster than how supply it's falling? All right, and therefore price is still going down. Which, of course, if true, obviously it doesn't bode well for the overall global economy, right? And then we still have that. I mean, I'm not even sure if the term was actually correct. I called it an arbitrage because in my mind, it is an arbitrage in between, nat gas and oil. Um, so up until that one is not closed in, I think, oil still has the chance to come a bit lower, and nat gas still has the chance to come a bit higher, up until the point that arbitrage is closed in and that market inefficiency has been rebalanced overall in the broad energy market. All right. But can't really get into the details of it. It would take another hour to talk about it. So let's just leave it at that for the moment. Um, Still think, overall bearish biased on a medium slash longer term. Um, Short term or intraday, intra-week, well, wouldn't be surprised to see another tiny attempt of a bounce, or at the very least, being sloppy, getting into a little bit of a consolidation for a few days. But other than that, I don't have even on this one, I don't have a strong opinion. You know, if it just shit itself, yeah, it would fit the bias overall. It's just, one thing is having a bias over a medium to long term. One thing is saying, yeah, it's going to drop 10% tomorrow. It doesn't happen like that, right? Not always, at the very least. Or not without very strong or unexpected catalysts. So, yeah, neutral, but again, medium term, still bearish, right? Let's have a look at gold. Now, gold, it's interesting right here. Look, we were looking at this rejection at these levels. That was the Friday's close. And, the assessment was, look, at the end of it, if you check just this small price segment right here, and bear in mind, we are looking at futures and we are not even looking at a back adjusted chart, right? If you look at spot, it is actually different. Or even if you back adjust this one, as you can see, it is a bit different, right? Still, that type of movement right here, it resembles a lot some sort of a swing failure pattern. And then, when you see on Monday, kind of like continuation with conviction, and we break below the previous weekly low because that was the previous Monday low, right? At that point, you know that something may be up with gold. And again, here is where you still need to differentiate and to kind of compart keep in separate compartments, right? Your long-term views and your short-term views, all right? Because although these was looking right like some sort of a pattern which would have brought farther downside, what we said was still, up until the point we take out a few lows. It could be these ones, it could be these, most importantly, the July low, right? So the previous monthly low. Up until the point we don't really see an acceleration to the downside. Uh, all of this is happening in the context of a market which is just ranging, not really going anywhere. So again, ranging behavior is going to be ranging behavior up until the point it lasts. It's kind of like the trend, right? The trend is your friend until the end of the trend. It's kind of like the same with markets, which are just range bound, right? So not a lot to read for me in gold currently. As I anticipated, a lot of different markets exhibited the same behavior, right? Yeah, spike in volatility, but no directional moves so far, or at least not confirmed. Um, could we come a bit lower than this? Yeah. Actually, I think we could. Um, and how much? Well, if you just look at the futures, probably this level right here, 3,340, something like it, as your preliminary type of a level where you would expect at least a bit of a reaction. I'm not talking about a sudden reversal and trend continuation, but at least a bit of a reaction at this level, right? If we manage like to crack it to the downside, of course, there should be a good amount of liquidity below these lows, so they they could be targeted at that point. I don't know if it's going to happen all in 1 week, but just one step after the other, and you just keep on looking at what the market is doing, all right, and what it is supposed to do next, given what did previously, and how good the market is at in doing that, all right. So, for instance, once you've seen this wing failure pattern, right, if you want to follow that logic, you see a swing failure pattern and you say, okay, usually when you got a swing failure, you tend to have a decent amount of a pullback in a market. So when you wake up on Monday, your first assessment should be, okay, that's my expectation, a bit more of a further pullback. Now, what I need to look for is how good the market is behaving in order to confirm that it actually wants to pull back. And after a Monday like this, I guess you get your confirmation. And then, of course, you have a little bit of a stall in here. And then on Thursday, you have another down day. And Friday was a little bit of a dodgy, but still, it looks a bit weaker, right? So, hence why you might say, okay, we might have a bit more of a farther downside potential in here, right? But other than that, I don't think there is a lot to say about gold. Um, and probably this is going to be a constant for the rest of the charts. I'm going to tell you that straight away. Let's have a look at Bitcoin. Bitcoin was nice, I think. Last week we were looking at, I guess it was here as for the close on Friday. Yeah, right here. And it was interesting because we said, look, we need to push back into the previous range, all right, reclaiming it, and then we might shoot to the upside. It's interesting when you look at this and you take the previous run up with the exhaustion phase right here, the pullback, then you see there is another attempt to the upside. There is no continuation, okay? And the market just pulls back again and it keeps on bouncing once again, but no continuation. And then the market goes down. And this was the point when I said, did we already have that pullback that we needed in order to, propel the market higher? And I said, well, look, I'm not saying it's not that, but I would expect a bit more of a dip in order to shake out a few of the weekends at the table. And we ended up having it. Now, it was interesting because why the market was kind of printing this range right here, all right? It was establishing this range. It was confirmed by the fact that the majority of the volumes, as you can see, were taking place around this AQ right here, so the midpoint of the range. Then we deviated to the downside at this level right here. We got back in the range. We have a little bit of a stall around the EQ, and then we just jumped at the range high first, and then to the opposite side of the range for, basically a mirror trade. We just mirrored this type of deviation to the downside, just on the opposite side, so to the upside. So that was nice. What's now? Well, we came back into the range. We are now hovering around the EQ, so you could uh think of a range, a consolidation, a sideways market. You could think of it as, of course, a point of equilibrium, right? So, uh, in order to have trend continuation, at least the way I see it, right, you would need enough imbalance on one side of the book, right, to basically propel the market uh, far enough from the midpoint in order to be able to escape this point of gravity. All right. If it doesn't happen, or if the market is not strong enough on both sides, it could be on the downside or it could be on the upside. If there is not enough of a push, you will see the market which will tend to gravitate back around the point of equilibrium. Now, I call it point of equilibrium based on this range schematic. I'm sure if you're looking at other type of analytic tools, for you, it might be a point of control if you're looking at a volume profile, right? So, I mean, every single one of us will have his own different tools of analysis, and they're all legit, don't get me wrong. It's just a matter of terminology sometimes. I've seen many, many times different people, myself included, arguing with others or just debating, pacifically on simply a peaceful debate about stuff. And many different times you have different people using different methodologies, and they're all coming to the same type of conclusion. So it's just a testimony that sometimes it doesn't really matter how you look at things up until the point you actually have an edge in looking at things that way, right? So again, for now, Bitcoin up until the point we stay in the range, so which this point should be well in between 121 and 114, 115 to the downside. Up until the point we are in here, direction neutral, just still sideways action, right? Let's have a look at yields. They moved this week. It was nice because they moved down, especially the short end of the curve. It moved down a lot. Of course, for the inflation in line with expectations. So no further inflation in the cards. And then it completely, reversed after we got that PPI report. So at the end of it, if you zoom out enough, even these markets, they're not really going anywhere, especially the long end, right? The short end, again, but it's kind of the same story of the last 10 months at this point. The short end, it's a bit weaker and still is influenced by a lot of different narrative and expectations as for what the Fed supposedly will do in the short-term future. But you know, even if you want to accept that type of a logic, I still think it's actually the other way around. It's the Fed which is going to mirror what the 2 years is doing. So basically, what the market is suggesting. It looks like there is this tiny little bit of a dichotomy in markets as for the yields and therefore the underlying bonds. Whereas, the short end is signaling that maybe we might have a little bit of an economic slowdown in the short term. But, if you check the long end, still it's not so convinced. Now people will say it's gotta be the debt. We have a debt problem, and the market is demanding a higher yield to be compensated for the incredible amount of debt that we have in the US. We are going bankrupt and all the rest. Which, again, I'm not going to dive into that topic right now again because I don't want to waste a lot of time on it again. I would just say, look, could also be that maybe the market is demanding a higher interest rate on whatever type of a long-term debt because the economy is actually set up to do fine. Maybe not in the next 6 months, maybe not in the next year, but we're looking at 30 years, right? So could be, could it be? Yeah. And again, so is it a problem of the debt if the market is demanding a higher rate because, those treasuries will need, on the long end of the curve, they would need to yield you more in order to compete and to attract capital when they need to compete with other investments in the real economy, which might perform particularly well. And therefore, it shouldn't make sense for you to invest in bonds if you can take risk elsewhere and being compensated even more, right? So the bonds, if they want to catch a beat, they need to promise you, they need to allow you to grant you a much higher yield. Otherwise, you're not going to buy them. Because again, my thesis, or at least the thesis, it's not mine. I didn't create that, but I just embrace that. To me, yields are just a reflection of future inflation and economic growth. So for me, the debt doesn't really play the huge role everyone is trying to to put on it. Right. So yeah, we got the same exact opposite movement in the underlying treasuries, and we are still looking at the futures with the long end, which came back down into this sort of a base that was established before the push to the upside. I mean, basically all of them move the same. It's just, this one, it pulled back a hell of a lot less compared to this one and compared to this one. So that's all I would say, and I would say as for the bonds, all right? Now, before moving into stocks, let me check one thing. I had a little bit of a slide deck or whatever you, and I'll get back to it right away. All right, so the slides are actually in order, but first, let's have a look as usual to the price action. Now, the market moved to the upside, as you can see. Now, we kept on following kind of the same theme, right? Up one day, pull back the day after, and then another move to the upside, and then another pull back the day after that. But ultimately, we had a very bullish week if you count from Monday to Friday. A bit of a weakness getting into Thursday and Friday, especially in the Nasdaq, right? But overall, if you check the S&P or ES futures in this case, I mean, not bad. They closed relatively near the highs. And Nasdaq, they came back into this sort of a much bigger bulk of liquidity, but still not particularly worrying right now. Um, if you zoom out and if you check all the major US indices, what you see is that, as usual, the Nasdaq, the S&P, they are performing particularly good. The Dow, of course, is following up, but as you can see, we don't have new all-time highs for the Dow since December 2024. And same for the Russell. We don't have. I still have the tiny little emoji for the Russell. Yeah. So still to me, it's kind of the same. Like you see that the sectors which are performing are those which are benefiting from bigger market caps and sorry, stocks which are related to companies which can generate profits from abroad instead of something like the Russell, which for me has always been more of a representation of the US domestic industrial or corporate base. Pick the terms you want, right? So if you just check the technicals, I think, although the wick was particularly at the end, bullish enough, let's call it that, it wasn't, it looks like we're just looking at price action, all right? It looks like we especially in the second part of the week, we lost a bit of a momentum. That doesn't mean we're gonna have another pullback or mini downturn very soon. Well, not necessarily. I mean, if you just check the moving averages, we are still above all of them. And we just made new all-time highs. And what's the thing with new all-time highs? That they are like the cherries, right? One calls the other, or one calls the next one. So up until the point the market is breaking highs, it's hard to be full on bearish. Which on one side, market structure can't be denied, but by the same token, you can't really deny something like the fact that we are building divergence on the RSI now. Uh, the MACD actually triggered a buy signal, but at this level, it's a bit high for me. And when I check the histogram, I don't really see the type of impulse or the type of a momentum build up that I would like to see. Something like was built up in here, for instance, when we were basically rebounding from the April lows. The stochastics for now still, it's pointing up. You might say it's an overbought territory, but I've been looking at the stochastic for a while now, and you see it can stay overbought like a lot. So the stochastic in and of itself, just because it's particularly high, doesn't necessarily means that you're gonna have an immediate pullback. Beyond the technicals, which for me, although they are starting to send out a few warning signs here and there, and we've been talking about them for basically the entirety of July, but still, for me, the overall type of potential weakness signal, it's not necessarily coming from the charts, so it's not necessarily on the technical side of things, but it is a bit more on on the fundamental side, on for once. But it's just the market structure or the underpinning of the market, the inner dynamics, the things, um, underneath the hood that then a lot of people are not really paying attention to, right? So let's start out with a bit more of a broad, um, you know, overview of the macroeconomic environment. All right, let's start out with these, for instance. So after the huge revisions, right, that we have been discussing in NFP the previous week, so not last week, but the week prior to it. Look, that surely it's not a good plus for the labor market, all right? Now, why could be important in the grand scheme of things, right? Well, because if you think about the labor market as the main type of source of income, and therefore, if you have an income, you have what? The capability or the ability of spending, right? So when you start to think of these relationship, now, for instance, here we got the percentage of total employees, right, working full time, right, and you see it's measured by the black line, and there is a very good relationship with PCE, personal consumption expenditures. Oh, that's the acronym that I just missed previously when I think I kind of get lost in the acronym before, but this is it, PCE, right? Look, it's natural that you have this type of a relationship because if you can actually have a full-time job, you're gonna earn a good chunk of money, obviously more than a part-time job, right? And you're gonna be able to what? Spend, driving personal consumption expenditure higher. And as we said before, PCE it's 70% of GDP, right? And the same type of relationship you see with PCE, it's kind of observable in CPI, right? So next, uh, what it's important to keep in mind is that PCE, as we've looked, when was that? 2 weeks ago, maybe. PCE has a very good relationship with future earning or forward earning growth, right? So again, where do all the companies in the S&P get their revenues from? Consumers. So consumer spending, aka PCE. The US economy, it's 70% consumption at the end of it, right? So it's interesting to note that with the situation with NFP, the labor market in general, and the wage growth, right? You see that we are not really on a good trend for now, in my view. And, that could impact down the road consumer behavior and therefore corporate or companies' profitability over time, right? This is another thing which could be alarming at a point. So we are looking at the rate of delinquency actually taking up like a lot in a lot of different things. Like, it could be student loans or could also be, I mean, this is just about student loans, but you can observe that in credit card debt, auto loans, and all the rest. So again, if you're going deep into debt and now you can't even sustain or service that debt, what does it tell you about consumers' behavior in the future, right? It tells me that they are a bit, maybe just a bit tapped out, right? Now, all in all, if you think again about the US economy being 70% consumption and all the rest should be what? Manufacturing, industrial, whatever. When you kind of come up with a little bit of a composite index, and this is taken by the ISM type of index, what you see is that at the end of it, we are in a very precarious situation. Is it not is not completely bad yet, but still, it's not good at the same time. So if it keeps on deteriorating from here, well, then you might have some problems, all right? And bear in mind that at least in recent times, if you take out the financials and the big tech when it comes down to earnings growth, the rest of the S&P alone would have seen negative earning growth. So you see how one thing is linked to the other, and how you could have some sort of a downfall of effects, right? A chain reaction, so to speak. Which is why I'm not particularly exuberant, right? Not saying that I'm giga bearish, but at the same time, I'm not particularly exuberant overall, not on the economy, or nor on the solidity of the stock market when you look again underneath the hood, right? I think there are cracks there. I think that there is some sort of a fragility which is building up. Doesn't mean the market should crash tomorrow. It just means that, you know, the risk is increasing. So if you keep on behaving and managing your money the same way you were doing, I don't know, 2, 3 months ago, now you're doing it, but your risk profile, whether you are acknowledging that or not, it's actually changing, and you're taking on more risks, right? So just bear in mind. Now, look, uh, another sign that we could, you know, coming into a situation where a pullback could be due is the fact that you have seen the speculative trading getting particularly high. So a lot of people betting on, I guess now they are calling them the dork, right? We transitioned from Roaring Kitty, GME, AMC, and now we got these dork. It's another bunch of penny stocks, and people are actually trying to pump them in order to make a lot of money, and then just, as usual, dump them in order to realize the gains. But still, when you get into speculation with meme stocks, usually what we've seen is that we are near what could be some sort of a short-term top. Again, doesn't mean we're going to have another 2008, another dot-com, but just maybe a little bit of a much deeper correction compared to the recent 3% that we've seen in the S&P, right? So just again, bear in mind. Now, when it comes down to market fragility, of course, everyone now is talking about concentration. So the breadth of the market being particularly narrow, although, at least up until the middle part of this week, it was looking like it was improving just a tiny bit, but overall, it remains particularly narrow. And you can observe that in the price action, in the market capitalization, and even in the price to earning ratio, or, yeah, I just said that the capitalization, so the weight of the top 10 stocks in the index. So again, usually, market concentration, narrow breadth, it's not a good type of sign for the market. Same for earnings, right? You see that the only companies which are growing earnings are mostly tech stocks, right? All the rest, it's kind of flat. They're not going down, right? They're not decreasing, but surely they're not going up at the same pace. It's kind of the same type of, data that we have looked at when we were comparing the different sectors as for earnings growth, right? And again, what we got, it's the price to sales ratio, right? Still, in other metrics, another type of assessment as for value evaluations, and it's particularly high at this point in time. All right. Now, does it mean that just because something is overpriced or it's too expensive, does it mean it's gonna crash tomorrow? No, it's the same old logic of a market can stay overbought for quite a good period of time before actually pulling back or completely reversing. And the timing of it, oftentimes it just needs a catalyst on its own. But it could be a nice way to assess risk and to decide what type of a risk profile you would like to have. So, AKA, to manage your greed. All right. Then again, if you check at the market cap weighted index and the equal weighted index, what you see is that there is now a tiny bit of divergence, which is getting, I mean, tiny bit, of course, figure of speech, but it's getting wider by the day at this point. And again, still another uh, point for the market concentration type of phenomenon we are looking at right now. If you then check the ratio in between the market cap weighted and the equal weighted index, what you see is that we are reaching into levels that we have not seen since the financial crisis. Again, not trying to scare you off or not trying to tell you sell what you got, go hide under a rock for the next 2 years. I'm not trying to say that. I'm just saying that again, the risk assessment you should have, it's different now compared to what it could have been again 2, 3, 4 months ago, right? Just at least be aware of that. This is kind of the same at the end of it. It's just the same type of relationship expressed though in between. So you got in blue the ratio we were looking at before, but the top 10 as for market capitalization in the index and their behavior. So again, it shows you that you have these concentration and this behavior and this relationship in between the market capitalization weighted index and the equal weighted index, and it looks like a lot of that it's the result of the behavior of these top 10 weighted stocks in the index. So again, still back to concentration. Oh, similar story with the Nasdaq. Even inside the Nasdaq, what you see is that, well, the index actually made new highs, but 40% of the stocks which are actually in the index are still below the 50 days moving average. So again, breadth, no cool, right? No bueno. And there is a divergence not only inside the broad market, but even if you check, in between the same risk on assets, but different type of sectors. You remember we were looking at the S&P and the Nasdaq against the Dow and the Russell. So small caps in this case, it looks like they rebounded, decently, I would say. But at the end of it, they are just a bit of they are following a little bit of these kind of a rebounding sentiment, right? But it looks like they could be set up for a bit of a pullback now, or a little bit of a. I don't know if you would categorize this as a fade. So if you just look at the futures on the Russell, I mean, we broke out off of this level. So the point now would be maintaining and confirming the breakout. If you see this entire move being faded and the market getting back below this level and giving all it back, that's not a good sign at that point. I guess that's the reason why this chart is just the way it is, right? So it's sentiment again, small caps returns, right? And look, even if you check the differential in between the returns in the S&P compared to the Russell, there's just no story there. The Russell constantly underperformed the S&P. And it's not just over the last 5 years. I guess this is something which you could have been observed, even if you get a bit more back in time. All right. So again, there is nothing wrong in being long one asset or the other, but just always remember what type of long-term behavior you are looking at when you decide, for how long you would like to stay invested in, I don't know, X instead of Y, right? Just for the sake of it. And of course, there is no need to remind which market, when it comes down to returns, has been the king over the last, 15, but I would even say 20 years maybe. Will it change at a point? But maybe, yeah. Everything changes sooner or later, right? But I guess this is some sort of a reminder of, the old sell America trade, the old America is doomed type of a trade. Europe is overperforming. Yeah, for the first time in 15 years or 20 years, Europe is overperforming for the first 6 months of just 1 year. There there must be a paradigm change right there, right? Right? Oh no, it was just an outlier. It lasted 6 months, and then we got back to the previous IMO. right? So again, when it comes down to long term, always remember that these trend it takes a lot to reverse them, right? And even if you check and if you look, as we've just did, at a breadth which is particularly narrow now, after the pandemic, and again, you might find and identify the codes of the reason you want. It could be the money printing, it could be the stimmy checks, it could be the government going crazy with the debt. But although we had many different periods where the breadth was particularly bad, uh, they didn't necessarily coincide with huge corrections or reversions in markets, right? So again, bear in mind, a market can be particularly concentrated, a market can be particularly bad from a breadth standpoint, but that doesn't mean that we're going to have a huge correction just because of it, right? Volatility for now it's particularly low. So if you check the move index and the VIX, they are particularly subdued for now. So this on one side, it is good because up until the point volatility is low, the market should keep on grinding higher. The point is that it can't just get so low, right? I mean, at a point, it's gonna have to come higher again. And look, we've seen the VIX at what 14 last week, then it spiked up to what maybe was 18, but it lasted just for so long. The point is, when you start to see volatility picking up a bit, and it's going to happen, right? It's guaranteed. It can only, uh, you know, contract and expand. So it's just like a rubber band. Sooner or later, it's going to snap. So overall, with all these things, and when you start to factor in the seasonality, as for the VIX, as we were looking at last week, and as for the overall market returns, especially in post-election years, and then when you see these type of reads when it comes down to sentiment, which you know, uh, for some reason, it's not particularly good, even if the stock market is making new all-time highs. The amount by which fund managers are overweighted stocks, it's not particularly huge compared to previous uh, iterations of this chart right here. But at the same time, the point is that still, again, take it with a grain of salt. It's still a survey, but it looks like a lot of people are actually thinking that the market it's a bit overvalued now. So if you pair that up with the fact that cash levels at very low levels right now, or should I say, yeah, cash levels, yeah. I mean, it's kind of the same. If everyone bought and they already deployed all their capital, who's left to buy, right? Same logic. So, I mean, many different things, but a few cracks are there, right? Hence why I said I'm not necessarily bearish the market from a technical standpoint. It's more the type of risk assessment that is changing for now, while I'm looking at all these different metrics changing around and getting into extremes when it comes down to a few of them, right? Nonetheless, we're looking at a record announced buybacks, right? I mean, maybe 2018 was, if you're looking at July, right? This is the highest on record, at least for July. Now, we'll see how it keeps on going for the rest of 2025, but yeah, kind of huge, all right? There should be, uh, do we have time for that? Yeah, I think we have. Buybacks, look, overall, they are one of the major reasons why the market is going up, right? But I don't know if you want to categorize it as a matter of semantics or as a matter of philosophical discussion, or if you want to bring it on the plane of morality. I just thought it was interesting, and we might spend the last 5-7 minutes of the video on that. When you think about buybacks, right? Now, the narrative tells you that they are a return on investment that the company grants to the investor, right? Because if we just buy back our own shares, we kind of increase the odds that the market will keep on going higher. And therefore, if you're invested with us, you're going to see price appreciation as for your investment. But, is it really a return on investment? So, just briefly, 5 minutes. This is the current level of buyback for July, 166 billions, right? So, all cool. We have seen it before, or at least, we were looking at before, right? Um, the point would be this. Now, obviously, there is a huge correlation in between shares repurchases and the underlying stock return, right? I guess nobody would argue that, or at least nobody would have difficulties in finding the link, right? But here's the point. If it is true that in July we got the most, or the highest on record buybacks, both announced and performed at a point, it is also true that we have seen something like this. We also had a record high level of insider selling. So when you think about buybacks, are they a return on investment for the the shareholder? Maybe, maybe not. Is a return if you plan on selling the stock at a point. Like, guess who? Insiders actually do. And you can just read the paragraph right here, right? So look, the point is the buybacks are just used to boost earnings per share, right? Without, that's the key point, without necessarily improving actual profits, right? Why? Well, I mean, if you're buying back your own shares, you are decreasing the outstanding supply of your own stocks. What's going to happen to the ratio, right? It's going to go up. Because if you just decrease the S in the equation and the E of earnings remains constant, the ratio is going to go up. Because the E is going to be divided for a smaller value. It's just simple math, right? I mean, I'm not huge at math, but I can get to it, right? And what happens if earnings per share goes up? Stocks go up. Valuations should go up. And it's a benefit for those insiders, could be managers, could be CFOs or whoever, which are actually paid. Part of their compensation is actually made up of stocks of the company they are running or contributing to run. And when the buybacks of their own company is announced, they're gonna collect their pay in stocks, right? And they're gonna unload the stocks in order to transform that kind of paper money wage in actual money wage, if you get what I mean. But for you, the shareholder, the investor, if you are still holding those shares, those stocks, while the entire process is taking place, you might say you are compensated with the fact that now you own, proportionally at the very least, a much bigger slice of the company you liked to invest into. But that doesn't tell you nothing about the improvement of the same exact company when it comes down to profitability, to capex, to R&D, acquisition, marketing, expansion, right? So again, is it or are buybacks really a return on investment for the shareholder? I say they're not, right? And there's no surprise we were talking about this. The S&P type of a bid when it came down to earning reports, the bid was around 80%. Voila. It was vastly anticipated, and we particularly mentioned 82%, if I remember correctly. Now, of course, it's not equally distributed across the sectors of the S&P, and surprise, technology and services, they did particularly well. Consumers discretionary, utilities and materials, they did a bit less well, right? But there is no surprise that if you can diminish the outstanding supply of your shares, you're going to boost up your earnings per share, and therefore you're going to have wonderful bits when it comes down to the forecast, right? At earning reports. So again, same type of relationship in this chart, the buybacks price index against the S&P 500 composite 12-month trailing EPS. So the relationship is still, they pretty much go hand in hand, as you can see. The buybacks, the stock market appreciation, and all the rest, right? So still, no surprises there. And here, I think, now I don't remember because it was throughout the week. I guess, if I'm not mistaken, this should be Apple. Yeah, it should be Apple. It's not the point about the company. I don't want to talk about one company or the other. It's just to show the phenomenon, right? So you see that sales for this company, which again, let's keep on calling Apple. You might want to check the data for yourself to confirm if it was Apple or not. But for what we are discussing right here, we are just interested in the dynamic, right? But let's say company Apple or company A, you look at the last 3 years, 2022, 23, 24, sales in billion dollars, they are particularly stagnant, right? But because of the buybacks, if you check over the same period of time, the outstanding shares in billions, right, they go down. So same sales, therefore same revenues, right, but less outstanding shares or supply of shares. What's happened to APS, right? It stays particularly elevated, and therefore it keeps on justifying a higher valuation of the stock, although the company is not growing revenues. All right. And if you check the latest Apple event and presentation, I mean, I might not be an Apple fanboy, but it doesn't look to me like they presented something groundbreaking in ages now. So this is why the phenomenon is important, and this is why, again, it's not necessarily a compensation or a return on capital for the average investor, but just for the insiders. What would be the reason, you might ask? And there was a survey on it, right? Why would CFOs, you know, performing accounting gimmicks and all the rest? And among the answers, the top one was to influence the stock. Why is that? Well, because my compensation, or a good chunk of it, it's made out of stocks. So if I can influence the price of the stock, and then I can just dump what I just received from the company, I'm transforming that stock that maybe I don't even want that, you know, I just want actual money in my banking account. Let alone if, again, I'm the CFO, so I know that the company is not really holding up very well, although we are not making it public. So as soon as I get the stocks and I know there are the buybacks, I'm going to liquidate the stock before something bad may happen over the next 6 months, 1 year, 2 years. I'm an insider at the end of it, right? So who, if not me, would be the first to say, you know what, maybe over the next 12 months, this stock is not going to perform particularly well because the company is not going particularly well, right? So again, just a few things about corporate share buybacks. If you're a speculator, all cool. If you do like to open up your charts and going long every single day when the buyback window is opened up, more power to you. If you're looking at it from another perspective, just maybe you would need to rethink a few things here and there, right? Now, a bit of an unusual video, maybe. Less charts, a bit more of slides and just discourse, but still financially related. And I guess, I mean, it was nice for me to find out, so I just thought I would have shared that. Other than that, I don't have anything else to share this week. Like, I think the economic calendar for next week, what could it be? Let's just briefly check that out. Do we have something particularly relevant? Building permits, housing again. No. What else? FOMC minutes. But this is just the usual. You don't have the actual conference, right? And no rates decision, so nah. Okay, initial jobless claims, of course. Oh, PMI, but this is just a composite. And this is just S&P Global Manufacturing, so it's not the ISM. I mean, it could move the market, especially intraday, but other than that, what? Oh, existing home sales. Well, this could be interesting. Probably not necessarily for the stock market, but if you are in the real estate market. And then what? Okay, well, we got Fed Chair Powell actually speaking. This could move market, to be quite honest. And other than that, mm, not a lot more. So maybe the highlight of the week will be Powell talking at the end of it. So, we'll see. All in all, I still think August tends to be a bit light on volumes. Wouldn't be surprised to see another week like this one with a massive move one side to then be, reversed for, the rest of the week, or to keep on having these markets which maybe you see a particular huge surge one day, and then the next day, the following day, the market just completely retraced back all the way before taking another step to the upside. But I don't know. I'm not really expecting the market to be particularly strong one direction or the other. Or I still think if we maintain the bullish posture, especially in risk on assets, I would still expecting a little bit of a grind to some degree, right? We'll see next week. So with that, I'm gonna wish you a very nice rest of your weekend, a very nice Sunday, and we talk again next week. Be nice and be cool. Nils out.
What have I told you since the first day you stepped into my office? There are three ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.